You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. Hey, what's up, savers? Cheers for tuning into the Savings Tip Jar, episode 164, for more savings tips, money news, and expert interviews. I'm Dom Beattie, the editor of Savings.com.au, and joining me in the jar is our senior finance journalist, Denise Raywood. And this week we'll be discussing the RBA holding fire on another cash rate hike and dialing down its inflation expectations. Does that mean we're done with the hikes now? Plus, property listings hit a 7-year high despite falling property prices. Is this the best time to be a home buyer? Also, the mortgage market meltdown, with our biggest banks reporting severe drops in the numbers of home loan applications. What does that mean for borrowers? Then, for our Dollar Dialogue, we talk to Scott Phillips, the Chief Investment Officer of the Motley Fool, about what everyday Aussies need to know about investing, as well as his take on the current markets in Australia and abroad. Don't miss that chat. And of course, we each share our savings tips of the week. But first, let's welcome Denise. Hi, Denise. How are you?
Well, thanks, Dom. Very good.
Good to hear, Denise. What's your savings tip for me this week?
Okay, well, when I run out of savings tips, as you know, Dom, I always go back to food. And my savings tip is the Sunday Arvo cook-up. And this is applauded by a lot of people, economists and nutritionists. Basically, spend your Sunday afternoon doing your meals for the week. And I personally do this probably from about maybe 1 o'clock onwards. I've put a couple of podcasts on. The Savings Tip Jar is a good one to put on.
Nice.
And I cook or prep my meals for the week, and that includes my lunches as well. Just on a Sunday afternoon, I have them all lined up in the fridge. They're there, ready to go. I don't have to think about what my meals will be for the week. I do run out about Thursday night, I have to say. So that would be egg on toast night. But, you know, it does take a few hours of your weekend, and sometimes I resent that. But when I open that fridge and it's after a busy work day and all those meals are lined up there for me to choose from, I'm glad that I do it. So that's my tip. It saves you heaps of money. Don't need Uber Eats. Don't need any takeaways. Just eat what's in your fridge.
Well, see, that's where the main savings from that strategy comes out of, right? Like, it reduces that temptation to, when you're sort of looking, what am I going to have for dinner? I can't be bothered cooking something, so I'll just, I'll just get some takeaway. When you've invested the time on that Sunday Arvo and you've sorted out all your meals for the week, it takes away that temptation. But like you said, a bit of a time investment, but like most investments, it pays off in that it saves you time through the week.
Yeah, it sure does. Yeah.
Down the line. So good one. It's one I don't think I've really gone to that length before where I've properly actually cooked everything for the week. But I do like a big cook up on a Sunday, and maybe I cook a big dish that is like 2 or 3 dinners, but maybe not the full week. But I might have to try going the whole hog and cooking up all the meals and seeing how that goes, because the time saving is particularly appealing to me. Good one, Denise. For my savings tip this week, I think I did already mention this one to you in the office this week, but the fuel price lock in the 7-Eleven app. I've probably mentioned it before, back when we had the last sort of burst in fuel price craziness, which we're going through a bit again now with the excise being lifted back up. So. I was just really struck with this. Is the first time it's actually really, really paid off for me. I managed to save $14 off the fill up of our SUV the other day because, just 5 days earlier, I'd locked in at 195 cents per litre for 91 unleaded. Sure enough, that the car was dangerously low on fuel. I don't know how we were still driving, because it basically said that we had 0 kilometres and left in the tank worth of fuel, and we'd driven several kilometres with it on 0. But anyway, we pulled into the nearest server we could find, and And yeah, it was a 7-Eleven, and the price was 216 cents a litre. And I was like, oh, I locked in a few days ago. I wonder if that still applies, because they have a time limit. Once you lock in on the app, I think you have it only about 7 days. And there's also a price limit. Like you can only save, I think it's 25 cents per litre maximum. Mine was, with that at 195 cents, it was a 21 cent per litre saving, which works out to $14 off the fill up, because it was quite a big fill up over 65 litres. I was just like, this is incredible. I really wish, people had told me about the fuel lock feature on the 7-Eleven app years and years ago, like long before all this crisis in Iran and the Strait of Hormuz and all that. I knew it's probably something I should try, but never really bothered until just earlier this year. But yeah, I really think I could have been saving so much money on petrol over the years. But there's also other perks to that, having that 7-Eleven app as well. There's actually a cool thing where after 6 eligible purchases, you receive a reward. And sometimes I'll just log into the app and it says, hey, you've actually got a reward waiting for you to claim. And it'll be like, various like snacks, or I quite like the donuts. It'll sometimes be a special type of donut. So
don't eat that, Dom. Don't eat the donut.
They're pretty good. Krispy Kreme ones especially. It's just a sometimes food, of course. But ordinarily those cost you about $3 or $4 from the server. But when they give them to you for free, that's it feels pretty good. And you also receive a reward on your birthday. You put in your date of birth, and they give you a little gift on your birthday. You just have to make sure you're scanning your 7-Eleven card after each visit. But like all these things, don't feel like because you've got the app or whatever, that you need to do all your spending at 7-Eleven to get all these perks. It's just one of those things where if you're going to be doing the spending anyway, you might as well get something for it. So I don't always fill up at 7-Eleven, but it's just like, it's also a good hedge against rising fuel prices. You lock in, and maybe that price you locked in isn't the best price at the time, but down the track, maybe it will be the best price in your area. So still try and fill up at the cheapest server you can. But if you happen to have locked in at a price that is much lower than what all the servers in your area are doing, you might as well make the most of it. So I do encourage people to check out the 7-Eleven app, particularly the fuel price lock feature. And that's my savings tip. All right, let's get into the Savings News Roundup of the week. Start off with the big one, Denise, the RBA.
Yes, it probably is the biggest financial news of the week. The RBA has decided to hold the cash rate at 4.35% in August. That was pretty widely expected. I think the odds were for a rise of between 0 and 3%. So no one was particularly thinking that there would be a rise. But anyway, it's always interesting to hear what is said at the time that these announcements are made. I've listened to a lot of these now. They say much the same thing, that inflation is still too high, and that the Monetary Policy Board won't hesitate to raise the rate again if they believe inflation needs to come down. And that's pretty much said at most of the recent meetings. There was a new statement of monetary policy released in August, updating what was released in May. And it does show a slight improvement in some of the economic outlooks, particularly for GDP and also for inflation. But they were just tweaks. It didn't really mean that we were going to get back to target with inflation any sooner. Things looked a little bit worse for employment outlook and the unemployment rate. But anyway, that's interesting to see. That's just the figures that the RBA will work on now, what they believe that will be ahead, and that helps them formulate their decisions. Of course, as they pointed out, there's a lot of variables in there, not least of which is that ongoing conflict in the Middle East and what it could do to fuel prices. And there's a few other things that, are always curveballs that can come up in the economy. Weak productivity was singled out as an ongoing issue, and that tends to be why we're having the inflation problem that we have. As soon as we sort of reach that productivity capacity that's in the economy, we start hitting inflation, and I guess that's the source of what we're facing now.
Yeah, well, I mean, that's true, but I feel like a lot of people aren't quite aware of that. I mean, a lot of people keep thinking that the reason we're having this inflation is just because of this this conflict that's happening overseas, and people aren't really aware of what's going on domestically. That's actually, putting our inflation up a fair bit higher than what we're seeing in other developed countries around the world. I think there was a comment that was left on one of our I can't remember if it was one of our podcast clips on social media, but someone sort of suggesting that, you've got the RBA hiking the cash rate because of something that's going on overseas, and you're basically hiking a non-discretionary, well, like this higher spending going on because of the higher cost of a non-discretionary product. I'll get the words out eventually. In fuel that people are kind of forced to pay for, and they're sort of saying you're just hurting people unnecessarily over this. But there are other factors at play. The productivity one is a big one, and it's kind of the RBA is forced to hurt people because with these productivity issues and government spending taking up a larger share of the economy, you've kind of gotten to a point where the economy can't grow too much. Like we can't have people going out and spending on lots of discretionary goods without inflation starting to get out of control. So then the RBA is forced to, in a way, to hurt everyday punters and make it harder for them to cut down their discretionary spending in order to keep inflation from getting out of control because of these other measures that is beyond the RBA's control to take care of. And that's really on the government, really, federal and state governments primarily to sort out this issue with productivity we have and also look at their own levels of spending. But, we've talked a bit about that on the podcast and we're no experts in that space. So I'll stop myself short before I start sounding like an idiot. But in my mind anyway, I think that's the real crux of the problem. And
it is, yeah.
I don't think it's going to get solved anytime soon. Yeah, I mean, there was something else I was going to talk a bit on that one. Yeah, in terms of, are we out of the woods yet? I mean, as I implied just there, no. And some economists, Shane Oliver, a good friend of the podcast, had him on the podcast plenty of times before. He's actually tipping another rate hike to happen later this year. I think it's actually November he's tipping. That would be the famous Cup Day rate change, which
the old Melbourne Cup Day. It's always a favourite, that one.
It is. I think I actually did a bit of data analysis and found that over history that has proved to be the most common time for the RBA to move the cash rate is November. It's something about it. I think it's because it precedes Christmas, and they sort of really, if you really want to impact people's spending, you got to make the change in November. It's a good one to sneak in as well without that's right. Whether that's if you want to spur on lots of spending, or if you really want to curtail people's spending, it's a great time for them to make the change in November to impact that. So that's. I mean, I think that's a bit of an outsider's view. Certainly, if you compare that to the Big Four bank economists, I'm not sure if any of them. I think it's ANZ. ANZ is the only one that has said they can see a little bit of a risk of a November rate hike. The rest is sort of sticking with there won't be another hike for the rest of 2026. Yeah. And ANZ. Even Westpac. Because Westpac was saying 2 until recently. Yeah, even Westpac. I checked this morning, and yes, that's what they're saying now, which it did strike me as a bit of a U-turn. But they've admitted that the data has been a lot more forgiving than they had predicted and based their earlier forecasts on. It's just ANZ and they certainly haven't said they see a November lift, but they have acknowledged the possibility there may be one. I do wonder, and this kind of feeds in a bit nicely into the next story, but I do wonder with the falling property prices that will do some of the RBA's heavy lifting, because we know the wealth effect, when property prices are rising, homeowners, which, that makes up like 60% of the population, they feel wealthier, and when they feel wealthier, they tend to spend more. But with prices starting to really drop quite severely in many parts of the country, that could dampen that wealth effect to quite some extent. So, but yeah, just getting into that story. This is not necessarily property prices plunging, but this feeds into it. We've now got a 7-year high in property listings, according to new data from Domain's July Market Insights report. So the story goes, home buyers are getting more choice and more room to negotiate, with property listings across the capital cities climbing to a 7-year high as sellers contend with tougher competition. Domain's July Market Insights report found total housing supply across the combined capital cities reached its highest level in 7 years, while new listings hit a record high for the month of July as more vendors brought properties to market. Yeah, I mean, it's interesting hearing that there's a lot more listings going on as property prices are falling, because I think I might have sort of even maybe mentioned in last week's episode how, maybe there's sort of a property price falls have a bit of a natural flaw to them because maybe sellers decide not to put their property on the market in a falling market because they want to maximize their property profits, right? But and that that there's fewer listings, then sort of reduction in supply on the market. You've got buyers chasing fewer properties, and that sort of naturally starts sending property prices back up again. But in this case, that we're seeing listings surging as property prices are falling. And I did wonder if that perhaps, Denise, is because sellers are trying to sell their home now before the market gets much worse. Do you think that's what's going on?
I think there's a bit of carry forward there. People who are thinking of selling at a particular time, maybe coming up. There'll be quite a few investors probably looking to sell before the 30th of June 2027 when the new investor tax changes kick in. Maybe there's a few of them that are just thinking, I'll get out of it while I still get the 50% discount as at a clean rate. So you might get a few of those. Plus, there'll be people that always just need to sell. And, you can't do much about that. If you need to sell at a particular time, there's many reasons for that. You can't avoid having to put your property on the market. And I do think, it's good for people who are looking to buy. But, as my next, our next story that we've covered, there's been a big drop in home loan applications, and that's been sector-wide for the banking and non-banking sector as well. And we're starting to actually get a few figures on that. It was sort of a bit of anecdotal evidence. But, of course, we've got reporting season in full swing at the moment. It's usually in August, and the big banks are all sort of revealing what their results are. CommBank's full-year results were released yesterday. We had Westpac earlier in the week, and we also got an update earlier last month from NAB, and ANZ is due to report its quarterly results tomorrow. So we can just sort of give you a basic rundown. CommBank has seen a 15% drop in home loan applications since May. That coincides with the federal budget, of course, and particularly those investor tax changes. Westpac's seen a 20% drop, according to their report. NAB had issued an update saying they've seen a 15% drop in home loan applications, and you can expect ANZ would be, much the same there when that report comes out tomorrow. I'll definitely check that. But interestingly, CommBank has said investor applications have fallen by about 28% so far. And just remember, it is only, in a very short time that we're talking about. If it's end of financial year, there's not that much of that's played out yet. So, we can say that a lot of that drop has been led by investors, but some other figures that we've seen, and they've come from the Credit Reporting Agency, have said that it's first home buyer applications that have dropped quite considerably below those levels as well. So even though the government says that they've dropped these prices for first home owners to sort of get in there and take their chance, we're not seeing that playing out as far as the major lenders are concerned. They have not seen first home buyers racing into the market, quite the opposite actually.
Well, I mean, I don't think the government ever actually said, yeah, no, we're dropping house prices. This is a deliberate strategy. I think they sort of were implying that, with those tax changes that, it would maybe keep property prices from continuing to rise out of reach for younger generations. But I mean, again, even with the mortgage market drying up, lenders will be desperate for new customers. So again, it sort of feeds into this environment where conditions are very favourable for those that happen to be in a position to buy in the market at the moment. You got huge listings, you got lenders falling over themselves to lend you money potentially, and then you might get a property for a bit cheaper than there was just a few months ago. So I'll stop myself short though of saying, as one politician, I can't remember who, said recently, that there's never been a better time to be a first home buyer, because I mean it would have been a much better time 10 years ago when property was substantially affordable, or even 30 years ago. But yes, certainly now if you do find yourself in a position where you've got the deposit saved up and you found some property that you like, things are looking a bit better than they were just a few months ago even. So that I'd take advantage of it for sure. I mean, it's kind of what last week's episode of the podcast I was stressing, that when you're buying a home, maybe you could find yourself in a position to get the property for less than the asking price. But obviously there's risks that your bid won't get accepted and someone else will snap up the property. But the same sort of applies with the mortgages. You might be able to get two lenders playing off against each other. One might say, oh, well, we can offer you 10 basis points less than them. And the other might say, well, we can offer you a cashback offer. So, I'd be really feeling the need to make the most of that situation at the moment, because a lot of it's kind of almost a perfect storm for home buyers. All these various factors happening in the market at this time. Very, very interesting time. Very interesting. All right, I think that wraps up the Savings News Roundup of this week. So time for our dollar dialogue. All right. Now, we talk a lot about the importance of saving on this podcast, but equally, if not more important, is investing those savings to help you take control of your financial future, which has never been more important. But with nearly half of Australian adults considered financially illiterate, investing can feel confusing, risky, or out of reach for many of us. However, according to Scott Phillips, the Chief Investment Officer of the Motley Fool Australia, the problem isn't that investing is difficult, but that it has rarely been explained in an accessible way. Scott is the author of a new book, The One-Page Investing Plan, and I'm pleased to say he joins us now. G'day, Scott. Welcome to the Savings Tip Jar.
Denise, thanks for having me. You've done a great job with the intro, because the issues you've identified are exactly why I wrote the book.
Oh, and before we get into all those issues everyone's dying to know, what's your savings tip for us, Scott?
Here's my one, is don't have lazy money. Make sure your money is actually when you've made the savings, put to work in a high interest savings account. We know there are billions of dollars in low or no interest transactions accounts around the country. Shifting that across into a higher, preferably high interest account, that is going to have your money making money even before you start investing.
Yeah, absolutely. 100% agree with that one, Scott. Yeah, people didn't really tell me much about any of this stuff till I was, I didn't learn about it until I was in my mid-20s really. But, while I was through uni, while I didn't have a whole lot of savings, I still had, a few grand here or there. But I just had most of it sitting in a transaction account. And I could have done with, the few $100s or so of interest I could have earned by having it in a high interest savings account back then. But I didn't learn that until much later. But I dare say there's probably some people well into their 30s, 40s that are still doing that. So that's certainly a good savings tip. Now, your new book, Scott, The One-Page Investing Plan, we'll start off with that one. Just give us a general summary of what it's all about, and also, who should read it? What could people expect from it?
Yeah, look, I really appreciate it, guys. And by the way, so if you want to buy the book, buy the book. If you want to get it from the library, do that. I'm not here to push the book necessarily, although I hope it's actually useful for people. And that's kind of your point. And I'll give you a very quick backstory to answer your question. I have the Vanguard Index chart. It's a chart that shows the 30-year history of the ASX. And it was up on my wall because I'm a nerd. And I had an internet guy come and fix my internet. And he looked at it and went, "What's that?" I said, "Well, here's what it is." And he said, how do you do that? Or no, it was can I do that? I was like, yeah. He said, how do I do it? And I thought that literally is the genesis of the book, is trying to help everybody take control of their finances. And obviously it starts with savings, as you guys know, but then turning those savings into investments and then having that build over your life, that's the next stage in the process. And you're right. It's absolutely doable by absolutely everybody. As long as you've got the spare money. Now, some people don't have the spare cash, right? I get it. So I'm not saying everyone, just regardless can do this. If you can save $1, you can invest $1. And that's the key. But how do you do it is the first thing. Secondly, how do you stay invested? What should you expect? And I mean, there's the standing joke, right, is the one-page investing plan in a 300-page book. So, can't I just have the one page? Everyone, I suspect, knows, or frankly could ask ChatGPT these days, what should I do? Or how do I invest? And you get a list. And the list is really important. And that is literally the heart of the book, right? Is here's one page. Do these things is the idea. But if all you see is the list, the how you do those things, and most importantly, how do you keep doing those things when everything around us is trying to distract us, put us off, fear, greed, impatience, other priorities, how do you stay the course? And those two things together are really the heart of the book. It's all about saying, here's all you need to do, and it's never been easier to invest. Online apps, index tracking, exchange traded funds, we won't get into a whole lot of detail. These things are there for you. Just putting the Lego blocks together is all you need to do. And that's the idea of the book, is to help people firstly understand what to do, and secondly, understand how to do it, and thirdly, how to stay the course.
It sounds like a really great plan, but as you say, there is always a little bit of fear out there about these things. And probably the current environment, we've got a bit of interest rate drama, and we've got all those investor tax changes, not to mention a bit of global conflict in the Middle East, and a bit of AI thrown in even. So, can you see that puts people, they don't understand those things and they fear treading there?
100%. Here's the other thing though, Denise, is that's always been true. The list was different 3 years ago. It was different 5 years ago. It was different 10 years ago. It was different 30 years ago. And again, the Vanguard Index chart, if your listeners Google it, do yourself a favor because it's really great. The top of the chart, and we can't do this easily in this format, but there's actually the things that happened in the world. The presidents, the prime ministers, the exciting and scary economic impacts. Over the 30-year period, so here's a really quick set of numbers. 10 grand, a hypothetical 10 grand, invested in 1995, became $143,000 30 years later. What did you have to do? Nothing. Literally nothing. But what you did have to do was exactly nothing, i.e. stay the course despite what was going on. Think about that 30-year period. We had the dot-com crash in 2000, right? The NASDAQ lost 85% of its value. We had the GFC. We had the COVID crash. We had terrorist attacks. We had China was going to fail. The system was going to melt down. All of those things that could have happened, and many that actually did happen, right? Despite that, the market managed to grow 14-fold in value. So you're absolutely right. There are so many reasons to look around and go, I don't know what to do. It feels scary. It feels risky. I might lose my money. I don't know what happens next. It's Trump. It's oil. It's terrorism. There's a million reasons, right? And I'm not downplaying those for a second. They are genuine and well-held concerns. Some of those will actually hurt the economy at some point. There are probably 2 or 3 recessions in that 30-year period. By the way, the US market did even better than Australia, and they had more recessions. So, work that one out. So, yes, understand the fear. Totally get it. Part of what I write about in the book is exactly that volatility. Here's the really scary part, right? COVID happened. And in a month and 4 days, the market fell by more than 35%. So, was it 35 days, let's call it? You went from having $100 to $65, or 10 grand to 6.5 grand, 100 grand to 65 grand. If you had $1 million, you lost $350,000, right? That is gut-wrenching. And wherever you are on the journey, that felt and is scary. But the market had the fastest recovery in history, as it turns out, and within a year or two was well above the level you were before it fell. So part of this is absolutely, I said before, staying the course. And it comes down to understanding history, understanding that fear is real. Some of those events, as I said, it's not even irrational fear, it's very rational fear. But the market has always, over 125 plus years, gained more than it lost through 2 world wars, a Great Depression, 2 now global pandemics, regional conflicts, 2 oil shocks, 2 bouts of hyperinflation or high inflation. We've actually seen that happen, and yet the market still grows. Doesn't mean it's not going to be volatile. So be ready for those big gut-wrenching just freak out falls, because they'll happen, but also remember that over time, the market goes on to go back to and then higher than the previous high. And if you can internalize that, it's not going to make it you feel any better. But if you can separate the two parts of your brain, the part of your brain that says, oh my God, I am just having a moment right now, and the other part that says, I know you are, just keep going. Again, not easy to do, hard to do. I did it during COVID, right? I made some bad investments during COVID too, by the way, not just great ones. But I went, this sucks. I'm losing money. I'm losing a lot of money. This is awful. I don't want to do this. I want to get off. But I said, but I knew this would happen. And I knew that I would feel this way. And I knew that I would decide to invest anyway, because history tells us is always, thus far at least, been the right decision to make. So yes, confront those fears, accept those fears, understand them. And in my mind, invest anyway over the long term, because the market creates value.
Yeah, certainly when you zoom out, it does look like time has a habit of ironing out all those bumps, and the market does seem to generally continue heading on in a northeasterly direction. But potentially that sort of trajectory is a bit steeper in other markets. You mentioned the US market, how that has grown even more than the Australian market in recent years. Just people I've been talking to, a lot of them are saying that they don't really see much investment potential in Australia as much as overseas. So I wanted to get your take on that, that sort of Australia versus overseas. Do you think, the Australian market it does seem like, over the last year, I think ASX 200 is only up about a bit over 3%, whereas in the US, a lot of their stock standard indices, the S&P 500 or the NASDAQ, they're all up over 20%. So yeah, do you think they're currently better growth opportunities overseas? I mean, it actually even seems like my super fund seems to think that way. I'm just looking at the portfolio makeup, and a bit over half is invested overseas. So what's going on there?
It's a really big question. I'll try and keep it short. So a few things are happening. Firstly, yes, there's more growth in the US right now. Why? Because the biggest companies are growing fastest. And that is kind of that symbiotic relationship. Why are they growing fastest? Well, because they're biggest. Why are they the biggest? Because they've grown fastest. So it's a bit of a chicken and egg. They are the ones, this sounds like a horrible marketing tagline, I promise you it's not. They're the ones inventing the future. So who are the companies that are biggest and growing fastest? Electric vehicle maker Tesla, social media company Meta that owns Facebook, WhatsApp, Instagram, chip maker Nvidia, which is powering the AI boom, Microsoft, Google, Apple, software and hardware companies that are just absolutely going bananas, right? Because they're harnessing the stuff that's going on. So you mentioned before, Denise, the risk of AI. We're also seeing the reward of AI thus far, at least. Amazon, own shares in Amazon. It is growing at a rate of knots. Cloud computing, AI, retail. So the combination, it's really, really impressive, Dom. And so the growth is real. And it probably will continue to grow faster, I suspect, than the Australian market. Why? Because of the makeup. We've got banks and miners. Banks are massive, but they're already the whole market. They can really only grow about GDP plus a little bit maybe over time, because they've already owned the entire, unless they expand overseas or do something else, they've kind of got the market. Miners, some really high quality long-term businesses there, but are they going to grow at .com rates? No, they're not. So you've got a very, very, very different makeup. I would say a couple of things. Firstly, I haven't got the numbers in the last 2 years. As of 2024, I think it was, yes. The Australian market actually outperformed the US over 125 years. So time frame matters a lot. Also, over the last 3 months, by the way, the ASX has done better, I'm pretty sure it's the last month, than the US market. So time frame matters. But I also expect that in different parts of different cycles, we'll see different things. Here's some numbers. I'm not going to bore you with a whole lot of detail. Over the past 5 years, oil or energy, the energy sector, we call it, basically oil and gas, and the tech sector have operated almost exact opposites and by big margins over the calendar years. So one will be up 30%, one's down 40%. Next year, one's down 40%, the other one's up 30%. And they've kind of tic-tac. Now, I'm not saying we should trade a yearly in and out. What I'm saying is in individual periods of time, investor sentiment and, frankly, macroeconomic conditions change really quickly. And so what we've seen over the last year, you're absolutely right, mate, have done fantastically well. Some of that is the businesses are growing. Some of that is investors are simply bidding up the prices faster than growth. And in that scenario, you generally find that if the share price gets ahead of earnings, there may well be future periods where growth in share price isn't quite as strong because earnings are catching up. So I wouldn't look at the last year and make any decisions. I will say I absolutely own international shares directly, and I own international ETFs. I own Australian ETFs and Australian shares as well. So I'm not saying do either. Well, the point is don't do either or is my view. I would absolutely want to be invested overseas for all of those great things. Currency diversification, geography diversification, sector diversification. Some of the companies that you can't get access to, the Amazons and the Apples and the Facebooks of the world in Australia. So you want to own them, and you've got to do it on international markets. By the same token, remember here at home, when tech has a bad year, because it's going to at some point, maybe it will be Australian retailers or telcos or media companies or maybe the banks and miners that do better. And so I wouldn't say you need to decide either or, and I definitely wouldn't just bet on one or the other, because you don't know what's coming next from earnings or from share prices. Remember the dot-com crash I just mentioned before? The Nasdaq fell 85%. Now, Nasdaq's gone on to outperform since then, by the way. So again, I'm not even saying they can't do well. All I'm saying is just because they've done well, the dot-com bust followed the dot-com boom, where things got really wackily out of kilter. So I own both. I reckon people should invest in both. You can do it, by the way, on the Australian Stock Exchange, because you can buy international ETFs, exchange-traded funds. Again, we won't get to the jargon, on the ASX. So you don't even have to have an international brokerage account. You can do it right here. So yes, there are some exciting, high-growth, really great companies in the US. I don't think we should forget here. Last one very quickly, Australian dividends often carry tax benefits you can't get internationally. So there are other reasons to invest in Australia as well as investing overseas.
Now, we've spoken about the Australia-overseas divide. Here's the other big divide that always comes up, and it's the old property versus shares. Are ETFs, which you've mentioned, exchange-traded funds, going to be sort of the new residential property for mum and dad investors?
I hope so. And I just people say, "Oh, you say because you're a shares guy." Here's the funny thing about it. Two things. Firstly, I'm a shares guy not because I work in a company that does this. I actually left my other job in industry to join the Motley Fool because I like what they were doing. Right. So the idea was I'm not just shilling for shares, because no one. I mean, I hope your listeners are getting some value out of the conversation, but I'm not going to move markets. Right. So am I just going to promote shares for the sake of promoting shares? No. I think they're a really great way of building wealth, and I'll come back to that in a second. So that's important. The second is, I like money. And so if I can make more money buying a property than buying shares, I'm going to buy the property, right? I'm not that silly. So I try to be agnostic, at least in the approach. I can't promise to be entirely unbiased, but I try to be agnostic in the approach, and then I'll buy whatever asset makes most sense. Here's the thing about property versus shares. Property is literally, as a sector, every building and land in the country, right? Residential property, commercial, we can put some differences there, but effectively it's everything, right? What are shares? Yes, it's every share in the country, but there's about 1,800 companies on the ASX. There's 2-point-something million businesses in Australia. So when you talk about shares, you're not really talking about the business sector. You're talking about a really, really small number of companies that probably are, on average, some are terrible, by the way, on average, better than the rest, because they get to list on the stock market. People want to buy their shares. If I had a private company, I could list it and make a fortune, I'd do it. So you can assume that most of the companies on the ASX are bigger or better than their competitors, or at least have something going for them. So it's not even a fair fight. If you said to me, Scott, you can pick the top 0.1% of properties and call that the property index, the property stock, the Australian Property Exchange, if you like, then I'd have a different conversation, different answer. But right now, we know over time, and here's some numbers, the Australian share market over the last 24 years I talked about before, 6% roughly before inflation. At about 3% inflation, again roughly, you're at 9% per year. The economy grows about 2.5%, maybe 3% a year if you're lucky. So you've already got a market that's well and truly outstripped economic growth, right? Think about property. Property's done extraordinarily well over the last 40 years. We all know that. Falling recently. But prior to 1980-ish, property grew roughly at the rate of wages, as it should have. So moving forward, what's likely to grow faster? The entire property market that has only wages and debt to grow, or a small subsection, on average, of the better businesses in the country that have historically grown at 9% per year. I don't think, I can be entirely wrong, right? So this is my supposition. Business has more headroom to grow, because if property grows at double the rate of wages for any extended period of time, eventually mortgages cost 110% of your wage, and that can't happen. So, well, maybe it's tenants. Okay, well, the landlord's got to pay back the loan with the rent. Now, I think if gears going away, you mentioned that, Denise. But even then, the rents can go up, but only, again, up to a certain proportion of income. You've got to put food on the table. You've got to put the kids in clothes. You've got to drive the car. So there's a natural ceiling. I don't know where it is, but there's a natural ceiling to property prices as a function of wages. The subset of companies that trade on the stock market, there's no ceiling. Why? Because they can always grow internationally. They can buy another competitor. They can put another competitor out of business. They can produce new products. They can become more efficient. There's a lot more potential, I think, for raw upside in the share market as a group than property as a group. So that's the answer. So do I think ETFs, exchange-traded funds, become the residential property of the future? I hope so for those people's sake. Yes, I think the returns will be better. I also hope, by the way, it's not part of this conversation, Australian property needs to be cheaper for our young people. We are really, really, really messing with them. And I own my own home. I don't own any investment property. If my house price falls 20%, then it's good. I don't care. And you say, well, it's easy for you to say, Phillips. It's not because I don't want to make money or want other people to lose money. I want, frankly, my kids to be able to afford to buy a home. I want other people's kids to be able to afford to buy a home. So, a whole different story. But if people are investing in shares, I think their upside is better, I suspect. The tax benefits, I suspect, will be better. And I hope that will mean fewer investors in residential property. Not none, because we want landlords, people who want to rent or can't buy, don't choose to buy. But I hope that transition will be better for those people investing and better for the housing market in general.
Great points there, Scott. Very, very well said indeed. Now, you've been very generous with your time. We've gone way over time, but I just wanted to quickly hear from you. What are your top investing principles before we say goodbye to you?
Cool. Save regularly, invest diligently, diversify properly, and stay the course.
Brilliant.
That's literally it. I will throw in reinvest your dividends, actually, because people don't always think about that. But that's it. That's the book, right? It's really people read the book and go, yeah, we know all that. I was like, good, so do it. Like actually take the lessons, take the plan. I'm not promoting the book, by the way. I'm just saying that's literally all that's required. It is not hard. Everyone, if you can save $1, you can invest $1, and you can invest it well with just a couple of bits of information. So yeah, they want to leave your listeners with.
That is one page. Well done.
Thank you.
Yeah, great note to finish on. Scott Phillips, really appreciate your time on the Savings Tip Jar podcast. Thanks so much for your insights.
You've been very generous to have me. Thank you.
Cheers.
Bye.
That was Scott Phillips, the Chief Investment Officer of the Motley Fool Australia and author of the new book, The One-Page Investing Plan, which is now available for pre-order. And that wraps up another episode of the Savings Tip Jar. Thanks so much for listening, and hope you're feeling a little bit smarter about your savings. If you enjoyed this episode, please give us a follow and a 5-star rating on whatever podcast platform you're listening on, and tell your friends about us. Also, if you want to get in touch with us, whether that's to ask a question, share a tip, or give us some feedback, you're more than welcome to via any of Savings.com.au's channels, TikTok, Instagram, Facebook, LinkedIn, X, or YouTube, or shoot us an email the old school way to inquiries@savings.com.au. That's inquiries with an E. And we'll be back next week for more savings tips, news, reviews, and expert interviews. So until then, stay savvy. Goodbye.